Greetings, everyone. Welcome to the Liberty Call. It is Wednesday, September 7th, 2022. Hope everybody's having a fantastic day out there. It is still hot here in Colorado. Not as bad as yesterday. I think we got up to about 95, which is a little toasty for where I live. So, and again, no AC. So it got a little warm in the upper levels of the house. So it's nice and comfortable down here. It's always 70 degrees year round. So, which is really, well, maybe not in the middle of the winter when it's like 5 degrees outside. We do have to turn the heat on down here. But anyways, hope everyone's having a great day. If it's your first time watching, please give me a big old like, share, subscribe, smash the subscribe button, alert, whatever, just so that you can stay in tune with what's going on in the financial worlds. So much better day today in the markets. Looks like some folks evidently think things are getting better. I don't know. Let's see. But I got some, we'll go over what happened in the global markets. Today's recap, trade deficit looks better. So that's some good news. Also got the Fed saying we have some weak growth. And what was this last article I wanted to go through about global tightening of global financial conditions. So some good stuff. So let's buckle up, strap in, and let's get to it. So, all right. Well, let's go ahead and look at the major indexes around the world. The Dow Jones came in today up 1.4% or 435 points, closing at 31,581. S&P 500 was up 1.84%, closed at 3980. NASDAQ up 2.14%. The best of the lot, up 11 or closed at 11,791. Was up 2.14%. Small caps are up 1.66. The VIX fell 8.44% today, down to 2464. Still in that yellow zone that as I like to call it, your yellow light. So again, when it's below 20, I feel pretty confident things are okay. But when it's in the 20 to 30, it's kind of nerve wracking. All right, moving over to Canada, they were up 0.8. Brazil was down 2.17. Mexico up 0.14. Going over to Europe, Germany was up 0.35. UK fell 0.86. France flat at up 0.02. Euro stocks flat at up 0.06. Netherlands was down 0.59%. Spain up 0.17. Excuse me. Italy flat at up 0.04. Switzerland down 0.27 and Portugal down 0.48. Again, both Russian markets were down today. The MOEX was down 0.98. The RTSI was down 0.7. Moving over to the Asian markets, Japan was down 0.71. Australia down 1.42%. New Zealand down 0.61. Headed over to China, the Shanghai pretty much flat at up 0.09. The SESE component up 0.42. The China A50 down 0.33. The DJ Shanghai was fairly flat today, up 0.05. And the Hang Seng was down 0.82, while the Taiwan weighted came in down 1.82%. So, like I said, much better day here in the Americas. It was not as good overnight in Asia. But again, the globe's a mess right now, folks. So certainly not anything to be shocked about. All right, well, let's go ahead and read through today's market recap. Let me shrink that back down. S&P 500 climbs as tech makes comeback after yield slip. Apple unveils new iPhones. Hey, that's exciting. We all need new phones. I mean, you should probably get one every 6 months. It's kind of like the jabs. You got to get a new and updated version, folks. All right. The S&P 500 climbed Wednesday as tech jumped after Treasury yields took a breather from their recent March higher, despite Federal Reserve officials reiterating the need to tighten monetary policy measures to tame inflation. Of course, my phone starts ringing as soon as I start talking and recording. Let's see here. Microsoft and Google led big tech up more than 1% and 2% respectively, while Apple was marginally higher after unveiling a slew of new products, including its iPhone 14, iPhone 14 Plus, and high-end models iPhone 14 Pro and the larger iPhone 14 Max. That's exciting. I'm not a fan of the Apple products. I don't know. It's just the user interface on those phones is, maybe I'm just used to the Android system. I had a BlackBerry years ago, and then I switched over. I think the had a Evo. It was probably the first Android phone I had, and I'm used to it. It's kind of like using Microsoft Office and the Windows platform. It's got its bugs, but at this point in my life, I'm just used to using it. Price of 14 will start at $799, and the Plus will cost $899, with pre-order starting September 16th and September 9th, respectively. I don't know why they don't reverse that. The iPhone 14 Pro will cost $999, and the iPhone 14 Pro Max will start at $1,099. Whew. Analysts have talked up the prospect of Apple's new phone triggering a strong upgrade cycle, as many iPhone customers haven't upgraded their phones in years. Quote, our estimates are that 240 million to a billion iPhone users worldwide have not upgraded their phones in over the last 3.5 years, Wedbush said in a note. Apple also released its Apple Watch Series 8 and new AirPods. Yeah, I saw something about that on the TV earlier, that some of the new features of the iPods was that it has a kind of like a tracking device, so you can, if you lose one of them, you can actually find it if it's under a couch cushion. Twitter, meanwhile, gained more than 5% after a Delaware court rejected Elon Musk's request to delay a trial launched by Twitter seeking to stop the billionaire from walking away from a deal to buy the social media company. The court did, however, allow Musk to add whistleblower claims related to security vulnerability and fake user accounts on the platform to his countersuit. Tech, which has been under pressure in recent days, was also boosted by easing treasury yields. Fed President Lael Brainerd said Wednesday that monetary policy will need to be restrictive for some time, and added that the central bank would need to see, quote, several months of low monthly inflation readings, end quote, to be sure inflation is slowing to the Fed's 2% target. Other growth areas of the market were also in the ascendancy, powered by rallying retailers, with Ross Stores, TJX companies, and Target among the biggest gainers. Energy was the sole sector in the red, following a 5% slump in oil prices, as weaker economic data from China stoked fears that slowing global growth will dent demand. Quote, oil's breakdown today is a bigger shot across the bow, pointing to further struggles ahead, in our opinion. We believe the commodity can break below 80 from here, targeting the mid-70s range in the weeks ahead, end quote, Janie Montgomery Scott said. So that's some good news as far as oil. We'll see if that is actually going to be the longer-term trend. My bigger concern for energy prices is that going into the winter, if Europe is in a supply crunch, it's going to lead to higher costs potentially globally. So, while we might see a little bit of a reprieve at the pump here in the short term, I think when winter comes along, we might actually see that start going back up. But things can change really, really quick. So we will see. All right. Next up, U.S. trade deficit narrows in July, exports at record high. U.S. trade deficit narrowed in July as exports hit a record high, a trend that could be seen trade continue to contribute to gross domestic product in the third quarter. The Commerce Department said on Wednesday that the trade deficit declined 12.6% to $70.6 billion. Exports of goods and services edged up 0.2% to $259.3 billion, while imports fell 2.9% to $329.9 billion. Trade added 1.42% percentage points to GDP in the second quarter, despite overall contraction in economic activity after being a drag for 7 straight quarters. And here's a chart. Let me make this a little larger so you can see it. You can see how we kind of bottomed out here a few months back at well over 100 billion, and we've made it back to 70 billion. So it is a pretty dramatic improvement, but we're still not close to the deficits we were at over the last decade, or even if we go back even further to where we actually we're kind of threading that line through the 70s and early 80s, close to the midpoint. So again, we got some work to do, but certainly not the certainly is some good news out of the economic data. All right, next up, Fed sees a weak growth ahead as inflation squeezes customers. The outlook for future economic growth remains generally weak at a time when rising food and rent prices have forced consumers to switch spending to essentials, according to the Federal Reserve Beige Book released Wednesday. Quote, economic activity was unchanged on balance since early July. The outlook for future economic growth remained generally weak, with contacts noting expectations for further softening of demand over the next 6 to 12 months. End quote, the Fed said in its Beige Book economic report, based on anecdotal information collected by the Fed's 12 reserve banks through August 29th. While there have been signs of a moderation in the pace of inflation, price levels remained highly elevated, according to the report. Quote, substantial price increases were reported across all districts, particularly in food, rent, utilities, and hospitality services, end quote, with most contacts expecting price pressures to persist at least through the end of the year, it added. The inflation squeeze continues to drive consumer consumption patterns away from discretionary items, the report said. Quote, most districts reported steady consumer spending as households continue to trade down and shift spending away from discretionary goods and towards food and other essential items, end quote. The tight labor market continues to prop up wages across all districts, though there were some relief in the pace of growth, with reports of, quote, moderating salary expectations widespread, end quote, according to the Beige Book. Despite the signs of easing inflation, price pressure still remain too hot for the Federal Reserve officials to tone down their hawkish remarks. Fed President, we already talked about that in the previous article about Ms. Brainerd. So again, it's kind of a good news, bad news situation right now. Some things are still okay. Some things are, not so great, like the inflation. But, I don't think it's all going to fall apart all at once. It's, we're going to kind of have like a little steps along the way as we as the market capitulates and the economy bottoms out and then starts back over. All right. Last article I got here. This is titled "The Tightening of the Global Financial Conditions Will Not Stop Until." And this comes from Zero Hedge. Despite all the hand-wringing and teeth-gnashing about lower asset prices and, quote, won't someone do something, end quote, Nomura's Charlie McElliott warns that a recent impulse tightening in global financial conditions, largely via the U.S. dollar and real rates, likely will not stop one or more of the following three events to unfold. One, the Fed flip-flops. Data allows Powell to signal a policy pivot without reminding markets of the 70s on again, off again, FUBAR. I'm not going to explain what that means. Not happening yet. The Fed desires the financial conditions tightening until inflation is on a clear path towards target. Two, China stops playing patty cake with negative RMB fixes. Digitals at 7 in CNH going to trade imminently, it seems, and instead truly eases with larger, more substantial stimulus and credit pumping to improve fundamentals, but only without ZCS, which is stifling any chance of recovery, and or Japan caves and adjusts YCC or intervenes in the yen. Analyzing each of the above, McElliott notes that the timorous piece this morning has enormous implications because of the Fed whisperer profile. It effectively now locks in a 75 basis point hike, and it renders only a 50 basis point hike as a de facto easing, where the financial conditions move off the back of only 50 basis point hike would be a massive counterproductive for the Fed's tightening cycle or goals. So basically what they're saying there is, we're not getting a 50 basis point hike. We will, at a minimum, we're likely to see 0.75 of a percentage point hike. And, it could be higher depending upon what happens between now and their meeting in a couple of weeks. So don't hold your breath on scenario one to stop the pain. As far as China is concerned, especially regarding the current weak attempts to manage the RMB via the fix, Nomura FX research Craig Cohn notes, today's fixing error of negative 505 PIPS is the largest since October of 2019. Although the market's reaction was limited, there has been a continuous negative errors since 25 August that we judge of significance, 10 sessions. It sustains concerns of the PBOC is acting against the RMB depreciation. Analyzing previous periods with significant consecutive negative errors, 2019, negative errors do not stop the US dollar to renminbi conversion from moving higher. An improvement in fundamentals is required. In May 2019, there were multiple errors over 100 pips as RMB weakened on news that the U.S. is raising tariffs on Chinese imports. Despite the errors, the U.S. dollar to CNY headed higher. In August through October 2019, there were large negative errors, regularly exceeding 500 pips. Despite the negative 593 pip error on August 6th, USD to CNY continued to head higher. It only started to decline in November of 2019 as the Phase 1 trade deal discussion started. The change in environment eventually led to a multi-year outperformance of CNH versus the US dollar on a basket basis. Currently, the environment is not conducive for RMB, and we reiterate our view to be long US dollar. Therefore, don't expect China to bail out your Netflix calls anytime soon. And so finally, across the ocean to Japan, global market stress is particularly evident in the Asian FX in recent days, with the Asian dollar index. The Asian dollar index is melting down to a fresh 19-year lows in standard crisis form. And we currently see the yen now accelerating higher again towards the 145 level, despite Suzuki stepping up comms using the phrase one-sided for the first time since 2018. McElligott notes that the rate differentials remain a large part of the story. Technically speaking, the long-term view remains for a rise towards 180 as the Japanese yen resolves higher from multi-decade base. Near term, the rise is nearing the 1998 high of 147.6, and this could invite a pause to the rally. Regarding the yen's weakness and intervention policy-adjusted risk, Nomura FX Research's Go-To Sans notes that we are approaching the level that prompted the joint currency intervention by the U.S. and Japan in June of 1998. However, based on verbal jawboning yesterday, we do not think the Japanese yen buying intervention is likely to near term. We do expect the Bank of Japan to adjust its monetary policy at the September meeting due to yen weakness as well. We will monitor the reactions of policymakers to the acceleration of the yen weakness, but in the near term, if there are no changes in the policymaker stance, the risk of the dollar to yen reaching 145 remains. Fed Chair Powell's speech on this Thursday, as well as the US CPI next week, are key event risks into year end. We still expect the dollar yen appreciation trend to inflect and weaken towards 130. So Japan is not expected to save the world here anytime soon either. That's three strikes against any short-term relief from tightening global financial conditions. And McElligott warns the CTA and other options-driven acceleration and reversal points are critical to understand as the speed of macro movements accelerates. So basically, long story short, basically he's saying that we're probably going to see a lot more of the same for the time being as all three of those things continue to be true. All right. Well, that's everything I had for today. Made this one pretty quick. So if anyone has anything for me, please go to dsafinancialgroup.com. All my contact information's there. You can send me an email, drop me a phone call, book a meeting, whatever you'd like to do. All right. Well, I hope everyone has a fantastic night, and I'll be back tomorrow. Y'all have a good evening. Bye.